Hello and welcome. I'm Vijay Srinivas. I'm joined by my colleague, Ms. Rachel Chitra as well. Welcome to the Federal Special Conversation on RBI Monetary Policy Committee outcome there. We're joined by none other than the Chief Economist of IDFC First Bank, Ms. Gaura and Gupta. Ma'am, thank you very much for your time. Let me begin with you there. The RBI has cut, rates once again to 6% right now, largely and widely anticipated, by the markets as well. And we also see surprisingly the change in stance as well from neutral to accommodative. What are your initial thoughts on this?
So the rate cut expectation was widely expected. It's driven domestic factors already supported rate cut because inflation has come off. Inflation is now below the target rate of 4%.
That's right.
And so it opened up space to ease policy rates. And the change in stance, that was a close call. It had become a close call post the tariff escalation. So our expectation was a neutral, but yes, it was a very close call. And the governor also clarified how this particular MPC is seeing the stance. So the
That's right.
stance is basically the future path of interest rates, and the accommodative stance indicates that basically rate hikes are off the table. It's only rate cut or pause. He maintained the delinking of the stance from liquidity conditions, which the previous MPC, like if you recall, Dr. Patra had also done, that they had delinked the stance from liquidity. But he also
Mhm.
gave us much more insights on liquidity and transmission and how they are going to go about increasing the efficacy of the rate cuts on the economy.
Okay. We don't really see banks transmissioning these cuts to the customers, considering the absence of broad-based reduction in both weighted average deposit rate and the marginal cost of lending rate. What's your response on this, ma'am?
They have begun transmission. The transmission started from April onwards. You will see bulk deposit rates across the banking system. It's begun to reduce. I agree the Feb policy took some time for the Feb rate cut to get transmitted by the banking system. But that was also because of the fact that the credit to deposit ratio is currently we've had deposit credit growth outpacing deposit growth for a while now. So there is competition among banks to mobilize deposits. And also the timing. For example, there is now much more clarity on how RBI will maintain liquidity conditions. For example, from December onwards, we began to see a change.
That's
But
right.
I think of late, the last, let's say the month of March, uh, there's much more clarity on the liquidity infusion from the RBI. There is clarity that they will maintain a significant surplus system liquidity. So,
Mm-hmm.
with this comfort, transmission will take place. RBI has already infused around 6.4 trillion of liquidity infusion. Uh, Plus, it's announced a small quantum of OMO purchases that it's conducting in the month of April that will enhance the transmission. It's already begun in April, and further transmission will continue because now you'll see system liquidity staying at around 1 trillion, increasing gradually. For example, in the month of May, we'll get the RBI dividend, which will get credit to the government of India, and that will help government expenditure pick up, and that will further enhance liquidity. So you can have a stage
Okay.
where system liquidity after the May and June will become around 2 to 3 trillion in surplus. Now that is a comfortable situation. For example, a 1% system liquidity surplus, or basically 2 trillion of system liquidity surplus, is comfortable, and especially if it's maintained over a period of time for transmission to take place. And this particular RBI is doing exactly that. You see the post policy press conference this time was very insightful, where he did
Mm-hmm.
mention what they see as uh, a surplus, sufficient surplus liquidity. That was a term he used. Sufficient surplus liquidity, which is basically, he said 1% of NDTL. So that's roughly translates to around 2.6%, sorry, 2.6 trillion rupees. For example, the deposits by the end of March 2026 is expected to go to around 260 lakh crores. So about 1% of that is around 2.6 trillion
That's
rupees,
great.
which will be the system liquidity, and it will be maintained consistently. Now, what was happening is that you would see banking system liquidity ease only when Government of India would spend. That would be
Mm-hmm.
basically month end, and then it would tighten during tax payment dates. For example, GST payment, advance tax payment, excise duty payments. So now you will have a consistent period of sufficient surplus liquidity maintained by the RBI. And to get that two, two, as per us, around 2.6 trillion of system liquidity, they will have to infuse at least 4 trillion more of durable liquidity. They've already done the lion's share of it last year in FY26. Around in totality, if you take even the till April, it's maybe around 6.8 trillion of liquidity infusion, which started from December, started with the CRR cut, then bond purchases, buy sell swaps. So these were the three instruments used. Now they'll need to infuse at least another 4 trillion in FY26 to keep system liquidity at this 1% of NDTL on a consistent basis. And that will definitely help transmission. More importantly, if you see the pace of RBI balance sheet expansion, which had slowed down last year, is now beginning to pick up, which is very positive for deposit growth. So is another factor that will support transmission.
Okay. Rachel, go ahead, please.
So, everybody's talking about the Trump's tariff. So, with global uncertainties like, say, like rising crude oil prices and geopolitical tensions, how do you see external factors influencing India's monetary policy decisions in the upcoming months?
So the governor definitely touched on it. They have revised down their GDP slightly to 6.5 from a 6.7, and global factors were mainly the reasons attributed. And so they have taken into account some impact of tariff, but we see further downside risk. So, for example, the extent of tariff that has been put on India, 27%, direct impact of that should be around 0.5% percentage points on GDP. So the risk is, so let's say if your GDP forecast is 6.5, which is currently RBI for FY26, tariffs can actually bring it down to closer to a 6%. So that's what 0.5 percentage points implies. So we don't think they've taken it into account yet in their forecast. You look at their assumption for global growth, they have still taken it at similar pace of around 3% in FY26 compared to similar to last year. So there is further downside risk, which implies that the rate cutting cycle can be deeper. So when you have softer growth, suppose tariffs result in a real slowdown global growth, as a result, every country will be impacted, not just India, and we are relatively less impacted because we are a more domestic demand driven economy. India's exports to the US is only 2% of GDP. Compare that to a Vietnam or a Canada or a Mexico, where it's a much higher proportion of the GDP is exposed to US. And so we are relatively better off. But let's say instead of a 6.5, the GDP growth actually goes to a 6 because of the tariff tension and slow down global growth. Your rate cut cycle for India can be a bit longer. So right now we are seeing two more rate cuts, one in the month of June and the other one in the month of August. So we are advocating for back-to-back rate cuts because of transmission delays it takes some time for the rate cuts to impact the economy. So it makes sense you cut back to back. For example, they've cut in Feb, they've continued to cut in April. We would expect them to cut in the next two policies. The tariff opens up the possibility for another rate cut. So instead of a incremental 50, it can increase to an incremental 75. So 3. So right now, our base case is still two more cuts, but the tariff opens up the possibility of a third cut.
So, beyond the monetary policy, what structural reforms do you think will be critical for sustained economic expansion?
So I think structural in India, there's always a combination of When you say structural, I think the main
So,
structural
what I
reform
mean
that
is like last budget, they had like more higher infra spending, but this budget there wasn't. So things like that, do you advocate for any particular shift in like which sectors do you think could most benefit?
so definitely the export sector will require more support given the brunt that they are going to face. If we assume this 27% reciprocal tariff stays in place and this current escalation where China, US has put now 104% tariffs, that means global growth will definitely take a hit. So the export sector will require fiscal support because of the difficult conditions that they face. The other thing is capex, private sector capex, which was as such not forthcoming because if you remove the tariffs, if you just look at domestic growth right now, urban consumption has been weakening. The wage growth in urban sector has been slowing down. In real terms, urban wage growth is around 2%, which is low. It was in FY24 first half in double digits. It's come down to 2% levels or low single digits in FY25. And that sort of slowdown wage growth means urban consumption will not be forthcoming. So if you see private corporate capex also didn't recover because if you're a company, you will not invest if you don't have visibility on demand. Now, given the external side with this tariff escalation, it's created even more uncertainty on external demand for a company. So under such situations, corporate capex will not be forthcoming. So government has to continue spending. The budget does incorporate a pickup in capex expenditure. It's it's in line with the GDP growth. So compared to FY25 in growth rate terms, there is an improvement. So that is definitely a plus. More importantly, state governments. So they are also a very large chunk. For example, state and center spend around 50-50 roughly on government capital expenditure. Last year, state government expenditure slowed down even more than center. Center, there was a slowdown, but state was even more drastic. There needs to be a pickup in state government capital expenditure also. If you analyze the state government budgets, they are budgeting an improvement in capital expenditure. The execution is key. And if you have to really talk structural reform, I think the main thing for India to solve is employment creation because we have a working age population that will grow for the next 25 years. We are in an environment where global growth is slowing. We are in an environment where there is this sort of move away from you can say deglobalization. So when China was growing at 10% and they were rapidly expanding their economy, they've also got help from the fact that the global economy was much younger and growing much faster. And there was globalization. Right now, you are in an environment where people are moving away from globalization. So it's a much more tougher external environment in which India will have to sustain its growth and ensure job creation. And also, labor intensive jobs, sectors which can create jobs which are labor intensive, and ability of the employability or the skilling of the labor force, that all of that has to be solved. It's not just job creation, they also have to ensure that the labor supply, the people that are available are skilled. So I think from a structural perspective, that's the main problem that India needs to solve: employment creation.
Right. So one of the things I discovered when I was talking to analysts, the center has the production linked incentive scheme, right? PLI. The thing is, like in certain states like Tamil Nadu, what they noticed is that it really did not contribute much to job creation as such, because many of these jobs were highly skilled jobs. It was not employing thousands of people, it was just employing a few hundreds. So when you have like more sophisticated production happening, it's not likely that it's going to create jobs at the scale that you're expecting. So that could be like the that's a plus with advancement and more sophisticated this, but it's also that like as you say, skill development, and will people be able to have you know get the jobs that they deserve. So my question to you would be like, What about the traditional sectors? Like, because RBI in its note said there are bright prospects for agriculture. One, they said due to healthy reservoir levels and robust crop production. So, do you see traditional sectors making a comeback because of this? Like the fact that everybody needs to be employed.
It's a very good point, and you're right, because it's very difficult for services sector to replace agriculture. So currently around 40 to 50% of India is still employed. Let's say 40% of India, if you look at data from RBI, is still employed in the agriculture sector. That 40% is contributing around 12% of the gross value added, or 12% of GDP, basically the share of agriculture in GDP. So that shows you the issue of productivity. How much is the per capita output an individual is generating? We have very high productivity that is happening in the services sector. We have high productivity in the manufacturing sector. But I would say the real creator of jobs is still the agriculture, where the per capita productivity is low. Imagine 40% of the population, employed population, is only contributing a small share of your GDP, while services sector is almost 60% of your GDP, and they are not employing anywhere close to the numbers that agriculture is able to employ. So you're right, if we can find a way to boost agriculture productivity, add value added or allied sector development, enhance per capita productivity of the people that are in that sector, that is one of the ways that we can maybe solve the employment creation. Because right now what's happening in the services sector, it requires high level of skill. You also have automation coming at the same time. So these are changes that you cannot fight. And also it takes time to scale the population at that level. So one, I think, executable area would be enhancing productivity of traditional sectors like agriculture. Also, for example, construction. For example, a lot of the people that are shifting from agriculture are getting absorbed by the construction sector. So real estate is actually quite important in terms of as a job creator, maintaining support for that sector, ensuring that there isn't a slowdown in that sector, because post COVID, we saw a pickup in real estate activity. Now, if that sector begins to slow, which can happen because if urban wage growth is beginning to slow, it will ultimately end up having an impact on real estate activity. So that capital intensive sector, which not cannot absorb people at the scale of agri, but can absorb at a scale which is much larger than manufacturing or services. So continued support to that sector, ensuring that sector doesn't slow down. That could be one of the immediate moves that can be made.
Thank you very much, ma'am. Very interesting talking to you. Thank you.